Now, I am more of a football guy, but in this case, I had an interest, a financial interest on how that game turned out. No, this wasn't gambling, and as MS Dhoni lifted that trophy, it led to an almost immediate increase of 8% in the per share price of Chennai Super Kings Cricket Limited. We'll come back to CSK in a bit, but in this video, we'll examine the market for unlisted shares in greater details as I try to answer the most commonly asked questions. If you like this video, then do give it a thumbs up. And if you have a question, then do let me know in the comments box below. Let's begin. A share in a company represents ownership in that company. So when someone says unlisted shares, all it means is that those shares have not yet been listed on the Indian Stock Exchange. These are also called pre-IPO shares or private equity shares, and we are talking about young, innovative, high-growth companies like Byju's, Oyo, and Ola, established companies with decades of experience such as the National Stock Exchange and the Serum Institute of India, subsidiaries of much bigger companies like Jio, Flipkart, Reliance Retail, HDFC Securities, and even companies like Otis Elevators and Capgemini that were once listed on a stock exchange but have delisted themselves. But remember, just because these companies are not listed, it doesn't mean their shares cannot be traded. In fact, the shares of some of the companies I mentioned trade quite frequently via the OTC market, which is otherwise called the grey market. Now, the phrase grey market might suggest to you that there is something illegal going on. But the truth is, trading in unlisted shares is not illegal in India, and this grey market is simply a network of brokers and dealers who buy and sell unlisted shares for themselves and for their clients. Having said this, I should also mention that these grey markets are not regulated by the Securities and Exchange Board of India, which means there is a lot less transparency and there's a lot more risk involved. But then why would one want to invest in unlisted shares? Well, there are a number of reasons, including an early exposure to high growth startups in promising sectors, the fact that ownership in these companies helps in diversifying the portfolio. Then there is obviously a financial incentive, and a lot of money can be made when the company goes public. And then there are some tax benefits which one can avail under certain schemes like Section 54EC and Section 54F of the Income Tax Act. But all said and done, investing in unlisted shares comes with its own set of risks and challenges. The first risk is, of course, liquidity, and one might find it difficult, almost impossible at times, to buy or sell unlisted shares. The second risk is capital loss, and it's possible the unlisted company might fail to perform, or it might even go bankrupt, leading to a total loss of investment. Then there is the risk of dilution, which reduces the value and ownership of existing shareholders on account of ESOPs, preferential allotment, rights issue, etc. And finally, there is the fraud element, and unlisted shares are prone to scams and manipulations by unscrupulous brokers and promoters, and the usual tactics include the sale of fake or duplicate shares, misrepresenting the financials or prospect of the company, inflating the price, the non-transfer of shares, etc. Actually, safety is by far the most commonly asked question by retail investors, and between illiquidity, capital loss, dilution and frauds, I think we can all safely agree that investing in unlisted shares is definitely a bit risky. In fact, I spoke to a couple of brokers, and from what I understood, there are weak links in each and every step. For instance, the first risk is the middleman himself, and you need to be careful with whom you work. Then, of course, there is the company about whom you know almost nothing of, and you have to rely on some research reports which again may or may not be credible. And then there is price discovery, and honestly what we call as price is actually nothing but a negotiation. Now, I'm not trying to paint a negative picture here, and if you're going to look at risk in isolation, then I think you'll be making a big mistake if you don't factor in the returns next to it. I mean, take CSK for example. The company was spun off from India Cement in November of 2018, and the stock was then valued in the price range of 12 to 15 rupees. At the current price of 185 rupees, this comes to a CAGR of But beyond these bells and whistles, the real question is, can I or can I not approach the regulatory authority, the SEBI, in case a problem does arise with my unlisted shares? The answer to this question is yes, and the SEBI can be approached to help you out in the event of fraud, manipulation, default, or dispute. But remember, SEBI has limited jurisdiction and powers over unlisted shares, and it can only take action against the seller or buyer only if they have violated the SEBI Act, the SEBI regulations, or the listing agreement. Nevertheless, as an aggrieved investor, you can also approach other authorities like the RBI, the Ministry of Corporate Affairs, or the courts in India. Now, there are many avenues through which one can acquire shares in unlisted companies. One can invest in startups via angel networks, crowdfunding platforms, incubators, accelerators, or venture capital funds. You can also invest via a PMS or an AIF. ESOPs can be bought from employees or promoters of unlisted companies. Shares can also be acquired from IPO allottees who are willing to sell them before listing. There are offline brokers or dealers who operate in the OTC market. And then there are the online platforms that connect and facilitate transactions between the buyers and the sellers. Of course, all these 6 methods have their own peculiarities, and before you dive into any of these, please do connect with some friend or connections in your network and try to learn from their experience. Alright, let's get into the process of buying unlisted shares. Now, while the specifics vary depending on the mode of investment, there are 7 essential steps that one needs to follow. The first step is, of course, finding a seller, and the top sources of discovery are through online platforms, brokers, and personal contacts. Step 2 is due diligence, and this part needs to cover a number of areas including thorough research on the company, its financials, the promoters, the growth prospects, the business risk, valuation, etc. Now, some intermediaries will have a PDF report, or they would have listed these details on their website, which obviously becomes an important read. But in case you are meeting the seller face to face, then here's a list of starting questions you can ask them, which will help you verify the authenticity, the legality, the important terms and conditions, and of course, the true intent surrounding the sale. The third step, and a rather important one, is the price negotiation. So as a retail investor, it is a bit difficult to judge demand and supply, but here are a couple of things that you can definitely do. The first is to talk to multiple brokers and sellers. You might need to bluff a bit. So to some brokers, you'll say, I want to buy 5,000 shares, and to others, you'll say, I want to sell 10,000 shares. It's an essential part of the process, and it's done to accurately determine the number of shares that are available and the kind of demand that's there for it. The other technique is a simpler one, and you can go to one of these online platforms and try to locate this section called InstaBuy, or there is some similar name. For example, in the case of StockX.in, I found shares of Reliance Retail, CSK, PharmEasy, etc. in this InstaBuy list, which gives me an indication that there are enough shares of these companies floating in the market, and as a buyer, I can do some negotiation. The next step, step 4, is the signing of a share purchase agreement. So an SPA is a legally enforceable document that sets out the terms and conditions of the sale and purchase of shares between the two parties. It specifies the number of shares, the price of shares, the completion procedure, representations, warranties, and stuff like that. Step 5 is, of course, the payment, and the investor should pay the seller through a bank transfer or a check, and should do that only after ensuring that the seller has a valid PAN card and that the promised shares are available in the seller's Demat account. The next step is the transfer of shares, which is something the seller initiates through an off-market transfer. And the final step is the receipt of shares, and if everything goes smoothly, the buyer should have them in his or her Demat account within 24 hours of making the payment. In addition to the shares, the investor should also receive a share certificate from the seller, or at least a confirmation letter. So these are the 7 steps that one needs to adhere to when buying unlisted shares, and in case you are the seller, then it's only a matter of reversing the flow, which starts by you finding buyers and it ends with you transferring shares to the buyer in exchange for money received. Now, there are a few questions that often pop up when discussing this buying-selling process, and I'm going to address 4 of them here. The first is the minimum investment amount, and honestly, there is no minimum per se. But from what I've read in many articles, the brokerages generally require 50,000 rupees of capital, while the online platforms are okay with a smaller sum starting from about 10,000 rupees. The next inquiry pertains to where one can see the unlisted shares after buying them, and the simple answer is the Demat account. So for example, this image here shows 40 unlisted shares in ISIN INE0DJ201029. I'm sure you would have seen ISIN a number of times, and it means the International Securities Identification Number, which is a 12-digit alphanumeric code that uniquely identifies a specific security. The other one, INE0DJ201029, is the code for API Holdings Limited, which operates the online healthcare and medicine delivery platform that is popularly known as PharmEasy. The next question is also a procedural one, and someone wants to know what happens to the pre-IPO shares after the IPO has taken place. Okay, so once the IPO happens, the unlisted shares become listed, and consequently these can be traded on a stock exchange. However, it's possible that the investor might have to wait for a certain period of time before selling the shares on account of a lock-in or a holding period. And the fourth question comes from NRIs who want to know if they can invest in unlisted companies, and the answer to that is yes. So NRIs are allowed to invest in unlisted companies on a non-repatriation basis. And in case the NRI wants to purchase on a repatriation basis, then the law requires them to notify the RBI, because a repatriable investment is treated as FDI, as foreign direct investment, which is subject to stricter valuation and pricing norms and therefore has a higher reporting requirement. I'm sure there are more rules and regulations around this, so do engage the services of a chartered accountant before engaging in any such activity. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips and stories that I continually post in the community section. Okay, so an interesting area of study is around finding the fair value of an unlisted share. Now, in its simplest form, a share's fair value is the price at which a willing buyer and a willing seller would agree to trade, assuming both parties have adequate information and they act rationally. But since information is the biggest gap when it comes to an unlisted share, there is no definitive or objective way of calculating its fair value. So how do we do this? Well, there are three commonly used methods of valuation that one can consider. The first is the comparable company analysis method, which involves comparing the company with its peers or competitors within the same industry or sector. This method is also called relative valuation, and an analyst would use valuation multiples like the P ratio, the price to book value ratio, price to sales, etc. to estimate a company's fair value. For example, say I want to figure out the price per share of Bundle Technologies Private Limited, which goes by the name Swiggy and is currently not listed. Understandably, there's only one entity that it can be compared with, and that of course is Zomato. But then if you want to do the same exercise for a Shriram Life Insurance or an HDB Financial Services or MobiKwik, or maybe for a Capital Small Finance Bank, then there are enough comparisons one can draw and therefore arrive at a measured valuation for the unlisted company. The second method, which frankly is more for equity analysts and not for everyday investors, is the DCF or the discounted cash flow method. Now, I have discussed this in a previous video, and to put it in a sentence, this method involves projecting the future cash flows of the unlisted company and discounting them to the present value using an appropriate discount rate. This present value of cash flows represents the fair value of the company, which can be divided by the number of shares to get the fair value per share. And the third most common way of valuing an unlisted company is the asset-based method. So this one's very simple, and all it does is that it takes the total assets of the company and deducts the total liabilities from it. What remains are the net assets, which represent the fair value of the company, which can be divided by the number of shares to get the fair value per share. Understandably, each of these methods would fit a particular type of industry or sector, and if you are a beginner to valuations, then I'll request you to do some reading and try to gather more information on how companies are valued. The final area of inquiry is of course taxation. Now, like any equity product, one has to pay taxes on the capital gain and also on dividends received from the unlisted company. Let's start with the dividends, and very simply, all dividends received are added to the investor's income and is therefore taxed per the investor's income tax slab. With regards to capital gain, any tax on it arises only upon the sale of unlisted shares, and that too only if it is sold at a profit. The actual tax percentage, however, depends on the holding period, and if the unlisted shares were held for more than 24 months, then these are tagged as long-term and the gains are taxed at 20% with indexation benefits. On the other hand, if the shares were sold prior to 24 months, then short-term capital gain applies and these are taxed per the investor's income tax slab. Now, while researching, I also came across some material that says that if an investor had put in capital in a startup under section 54EE or 54GB of the Income Tax Act, then tax on long-term capital gains are exempt up to 50 lakh rupees. I also came across a section 54EC and section 54F that allows investors to save tax on long-term capital gains by investing those gains in specified bonds or assets within a certain period. Now, as I've always said, taxation has never been and is definitely not my strong suit, and therefore I strongly advise you to consult a tax advisor or a chartered accountant before acting on any of this information. Alright, so we went through a number of questions here, and I hope there is a lot more clarity on where, why, how much, when, and how one can invest in unlisted shares. In my view, it comes down to a couple of things. Firstly, there is the effort angle, and investing in unlisted shares is both challenging and complex. And secondly, there's the investor's return and risk orientation. That is, how much can you afford to lose and what kind of returns are you expecting, assuming that scenario. But all said and done, I think this market for unlisted shares is only going to go up as more and more private companies start inching towards a public listing, and as the entire fabric of how businesses are run moves away from a promoter-led company in an informal economy to a professionally managed one in a formal setup. I sincerely hope you found this video useful. It was a bit informational, not much data, but hopefully it gives you a fresher perspective on how you can improve your investing portfolio. Please do like this video, do share it with your friends, do subscribe to my channel, and I'll see you 3 days from now. Until then.